In this step-by-step cryptocurrency leverage trading tutorial, I will go over everything you need to know right now in regards to trading cryptocurrency, Bitcoin, altcoins on leverage. I will make sure that you know how to not get wrecked. I will talk about the risks. I will talk about how you're able to make insane amounts of money using leverage and everything else. Welcome back, everybody. My name is Chris, bringing you cryptocurrency videos every day, teaching you how to make money in this market. If you're new to the channel, then make sure to subscribe and activate the bell right now. So before we start talking about cryptocurrency leverage trading and how it works, we need to talk about a few different platforms that you can actually leverage trade on. So a few exchanges that I'm using are Bybit, Fimex, Pionex, Tapbit, and of course OKX. Down at the description of any of my videos, you will always find the different platforms that I'm using. Also, you will find some offers if you want to sign up to these platforms. Now, most of these platforms works more or less the same. The big difference though is in which countries that they allow onto their platform. Now, if you want a regulated exchange, then OKX and Bybit are really good. Also BitGet. If you are from a jurisdiction that is not usually allowed on different platforms, then you can use Fimex, and also you can use Pionex. So if you use these links, you do get some nice bonuses. The exchange that allows the most amount of different countries is Tapbit, and they allow the most amount of countries, so they are the friendliest in regards to new users. However, I know that also a lot of people are asking me, are you able to use a VPN to start trading on these exchanges? That is up to you. Usually it does work to use a VPN to trade on these exchanges, but that is your decision to make. So now let us talk about what crypto futures trading actually is and how it works. So what are cryptocurrency futures? So with cryptocurrency futures, this is when you are trading on leverage. Now, when you are trading futures, you're actually not trading the actual Bitcoin. So let's say you were to go to an exchange on the spot market, okay? So you go here, you type Bitcoin, USDT on the spot market. So you can see the spot market right here. If you were to go here, let's say you click here and you buy Bitcoin, you type how many Bitcoin you want to use or the amount you want to use, or the amount you want to buy, and you click buy. Now you have purchased $5,000 worth of Bitcoin. Now with derivatives and contracts, it's a little bit different. And just like I said, when you're trading on leverage, you're actually not buying Bitcoin. Now, when you buy Bitcoin, you will always keep that Bitcoin, no matter what the price is. But with contracts, you're actually buying a contract, trading with the same price as the underlying asset. In this instance, it is Bitcoin. So how futures generally work is that the contracts specify that one party must deliver a cryptocurrency's fiat value to another party at a specific price by a certain date. Now, how this came to be in the very start is that futures contracts, these are not new things. It is not only in crypto. These have been used for commodities for hundreds of years already. And essentially, it allows you to lock in a certain good at a certain price. So let us take an example. Let's say that the US government, let's say you are a farmer and the US government want to buy boatloads of corn. Maybe there's a pandemic, maybe there's a war, they just need a lot of corn. So you as a farmer right now, you know that you got an order for massive amounts of corn, but you need different goods to be able to produce these corns. You might need fertilizers, you might need, water, and what else. Now, for you to be able to actually calculate and make profit and kind of hedge your profits here, you could enter into a futures contract for your supplier when you want to buy fertilizer. Because the disaster would be right now, let's say the US government wanted to buy very much corn from you, well, you have certain costs associated with that. What if the price of fertilizers goes up by 200%? Then you may not be able to deliver the corn that the US government wanted to buy for you, because the price of fertilizer which you need to produce the corn might be just too expensive. So it is a way to actually lock in the price at a specific point in time for a particular good. I hope that explains it, how it started from the beginning, how a futures contract actually works. Now with crypto, we don't have a specific date, although you can trade futures also with a specific date, but typically what you will trade is just perpetual contracts, which is just a way to long and short the market indefinitely. So there is no certain price point which the trade is going to be closed at compared to just regular futures. So why would you want to use futures to begin with? Well, if you use futures, you are able to go long and short. That means that you're able to bet on the price moving in either direction. If you go long, you are gaining money if the price of the asset goes up. If you're going short, then you are gaining money when the price of the asset actually goes down. So you're able to make money on both ways here. Also, why you would want to use futures is because you are able to use leverage with futures. So what is leverage? So leverage allows you to trade with more money than you actually have. So the leverage that you can use is between everything from 1x up to, on some exchanges, it's actually 125x and 150x even. Now, let me show you how this actually works. So if we go to contract here, we go to Bitcoin on Phemex. You can see that I'm able to choose here from everything from 1x, which is essentially the same as buying spot, and then you have up to 100x right here. You can go long and you can go short. Now, going with leverage or using leverage right here is extremely risky if you don't know what you are doing. So I would never recommend anyone to use anything more than 10x leverage unless you know what you are doing and you have a proper strategy in place and you are an experienced investor. Anything more than 10x leverage actually borders to gambling. So you don't want to be a gambler in the markets, guys. You want to be a trader with a specific strategy and with a specific risk tolerance. So what leverage will do is that it will allow you to trade with more money than you actually have. So let's say you have $1,000. If you use it with 10x leverage, that means that you're actually trading with $10,000. Let me show you here using the calculator. Most of these cryptocurrency exchanges will have a calculator on the order page. So if I click on the calculator right here, you can see if I were to buy one Bitcoin right now using 10x leverage, I want to go long. I enter it at, let's say, $100,000, and then I exit at $101,000. Now, if you just buy one Bitcoin, you buy it at $100,000 and you sell it at $101,000. Just using spot here with 1x, like just spot, it is the same as 1x leverage, you would be gaining $1,000, right? That's pretty simple. And if I do something like this would be doing spot. The profit would be $1,000. You buy it at $100,000, you sell it at $101,000. That's fine. Now, if you were to use 10x leverage, that amplifies your profits by 10. So now, all of a sudden, so they're actually calculating it a little bit weird here because you can see with 1x leverage, they're calculating like the margin you need to use is $101,000 essentially. But if you do 10x leverage, you can see to gain the same $1,000, you would only need to use about $10,000. So essentially here, you're using about $10,000 and some extras just in case to be able to make 10%. Now, if we slide this all the way to the right here and go to 100x leverage, you will see that when I click the calculation button, it will show that you only need $1,000 because you're trading with 100x leverage. So there you go. So $1,000 and some extras here. So essentially the exchange allows you to trade with more money than you actually have. And you can do the same thing for the other side. So if you want to do a short position, you can also do it with 10x leverage. And if the price goes down, let's say the price goes down to $90,000 here, you are at 10x leverage, you enter at $100,000 per Bitcoin for one Bitcoin, you are able to make $10,000 just using $10,000 in margin here. So 10x leverage, $10,000 worth of margin. So the value of the trade is actually $100,000. So why would you want to use leverage? Well, it is pretty simple. If you believe that we are going to go up, well, you are able to trade with more money than you actually have. So as long as you are correct in your trades, then that is fine. You're going to amplify your gains. However, the big risk here is that it also amplifies your losses. So if I go back to the calculator here, so let's say the trade were to go against me. So I want to buy one Bitcoin, I enter at $100,000, but then the price goes down to, let's say, $80,000. Now you can see that the $10,000 that I had in margin were already at a loss that would liquidate me. So what would that mean if I got liquidated? I will talk more about that in a little bit. But for now, just understand that whatever leverage that you are using, it amplifies the losses and it amplifies the gains. But because it amplifies the losses compared to when you're just buying Bitcoin, you're not going to lose that Bitcoin. You're always going to keep that Bitcoin. But when you're using leverage, there are certain risks involved here. So what are the risks involved? Well, the exchange will tell you that, okay, you are able to borrow money from us, but if the price of, or if the position is at a loss that is greater than your margin, remember, if we do 10x leverage, we are essentially, if we want to buy $100,000 worth of Bitcoin, our margin would be $10,000. Now, if the loss of the position goes down below the margin level, then the exchange is going to stop out that trade and they are going to liquidate you and take all of the margin that you were using. How you can prevent this is to use less leverage, or if you notice that the position is going against you, let's say you entered into a long and the position is going down, you can always add more margin to give you some more safety. You will always see the liquidation price when you enter into positions. It will also give you a warning before you enter, but you can also use this calculator here to calculate the liquidation price you would have if you enter into a trade. So let's say, once again, 10x leverage. I want to enter into a position worth of 1 Bitcoin. I entered into it at $100,000. You can see that my liquidation price would be about 90, it would start to liquidate me at $90,500, which would be what my collateral would be. So remember, if I have $10,000, 10x leverage, that is $100,000 that I am trading with. Now, if we go down by about 10%, that would be a $10,000 loss. So $100,000 was the entry price. If we come down minus $10,000, it will start to liquidate my position. Now, usually when you enter into a trade, and I will enter into a trade here just to showcase this, I will do a market order and I will just buy a tiny little bit here just to show you how you can actually add more margin so that you don't get liquidated. So when you have opened a position right here, you can click on margin, and then you can see that the current liquidation price that I have is $88,000. Now, if it gets closer to this and you don't want to get liquidated, you can always add more margin here to make sure that you do not get liquidated. And you can see that my liquidation price even disappeared here because I was adding sufficient margin. So now when I remove this margin, you can see that the liquidation price will come back. So just know that using leverage, there are certain risks involved with it. Yes, you can amplify your profits. You can also amplify your losses, and that is not obviously going to be very good. How much leverage should you use? Well, that is entirely up to you. But just like I said, I would not suggest anyone to use anything more than 10x leverage. That would be the absolute maximum that I think that anyone should use. Not financial advice. Of course, nothing in this video is ever financial advice. But using more than 10x leverage is probably not a fantastic idea unless you know exactly what you're doing. Using something like 4 or 5x leverage is something that is more manageable. But the main point is that you always need to keep track of the liquidation price and have a strategy for how you're gonna deal with the position if we start to go down. So a couple of different scenarios where you would want to use leverage trading as well is, let's say if you have a massive altcoin position. Let's say you bought a bunch of, I don't know, XRP. So let us just take this as an example. You buy XRP down here at 50 cents. And then you see that XRP has been going up insanely much. Okay, we go up by several hundred % here. So your XRP position is at massive profit. I'm not talking about leverage here. I'm talking about you buying it spot. Now, one idea could be, if you see that we have gone up extremely much, then you might want to hedge that position. So what does it mean when you're hedging a position? Essentially, it is a way to protect the gains that you already had. So you have massive gains on your spot position, the XRP that you bought, but you believe that the market is a little bit overheated. So what you could do is you could enter into a temporary short position right here. So let's say we go up to $3. You feel like even though you are bullish on XRP, you believe it's going to go higher, you don't want to sell your XRP. Also for taxes and stuff like that, you might not want to sell it. But what you could do is you could hedge the position short term. So you enter into a short here when you think that we are overheated, and then that short, you could close it when we go down. So we went down in this instance by 30% for XRP. So let's say you did that on 10x leverage. That means that you made 300% here on this drop. So let us do the quick calculation here. So 300% on that drop, what would be the profit here? So let's say you do it on 10x leverage. Let's say you have a position worth, I don't know, 5,000 XRP just for something. So we're going to short. So we go to the sell side here. Let's say you short it at $3. And then when we come down here to how low did we go? We went as low as $2. So you can see that you made 330%. The profit on that particular position, you only used $1,500, but you made $5,000 on that hedge. So then you can close that hedge. And then when you feel like the market is not overheated anymore, you can be more comfortable in your spot position because you already hedged, essentially locking in some of that profit. Also, another reason why you might want to use derivatives as a hedge is, let's say that you have a big position of a coin that is able to be staked. So for instance, a coin like, I don't know, which coins do we have that can be staked for some decent gains? Let's take Ethereum. So Ethereum, you're able to stake it and earn, I think, about 4% yearly. So same thing here. If you believe that we are overheated in the market, you can throw in a short hedge for Ethereum, and because you have a lot of Ethereum staked already, you're earning that yield, but you believe that you have reached a local top for Ethereum, but you don't want to unstake and sell your crypto, in this instance Ethereum, you can use a short-term hedge for that. Also, a third reason you might want to hedge is if you have entered into an OTC deal. So an OTC sale is essentially when you don't buy off the exchanges, instead you buy it directly from the team, or you buy it from a market maker, or you buy it from someone else. Now, these assets that you might buy, so this was a big thing in the last cycle for Solana. A lot of entities bought Solana for a discounted price. However, there was a lockup. So you could buy Solana for a discounted price, let's say for 50% lower than the market price. So you could buy, for instance, right now, you could buy Solana for, let's say, $100 per Solana, but you would only get it in, let's say, 2 years. So what you can do is you can lock in the price. Let's say you buy $100,000 worth of Solana, then you can short with the same $100,000, essentially locking in that price. And when you receive the tokens, you can close the short and also sell the Solana that you received, and then you can pocket that profit, because when the prices fluctuates, the value of your spot position, the Solana that you will receive after those 2 years or whatever, will go down, but the short that you have entered as a hedge is going to go up the same amount. That means that you have locked in the price. Whatever price difference is going to equalize out depending on the short and on the spot position. So are there any fees involved with using leverage and trading these contracts? Well, you have the normal trading fees, of course, as when you buy or sell on the spot market. The fees are actually a little bit lower on the derivatives market compared to the spot market. But there's another fee that you also have, and that is the funding fee. The funding fee you will find always when you go to contracts, you will find it at the top here per asset. Now, the funding fee is usually 0.001, or sorry, 0.01. So you can see it for Bitcoin right here. This is the normal funding fee. So each 8 hours, you are paying a fee to be able to use leverage. Now, usually, just like I said, it's 0.01%. It is just for the ability to use leverage. Now, this is going to fluctuate. So in times when there is a lot of bullish momentum, a lot of people are going long, the funding fee is going to go up. And it can get as high as 0.3% if we get really, really overheated. Also, if there's a lot of people shorting the market, just like I showed you here for Solana, if a lot of people are shorting, the funding is actually going to get negative. So what does this mean? If the funding fee is negative, it means that the longs are getting paid. So the shorts, the people that are shorting this asset, they are paying the longs. If the funding fee is positive, it means that the longs are paying the people that are short. And this is generally what you will see in the market. In general, in the market, the longs are going to pay the people that are short. So in general, it's going to cost you to be long on derivatives. The funding fees can always be checked here on each and every exchange. Depending on which exchange you use, you will always find it somewhere on the trading page. So just to wrap up this section here. So leverage allows you to go long and short. It allows you to bet on the price going up or to bet on the price going down. There are certain risks involved with this. If the loss of the position is greater than the collateral you put, then you are going to get liquidated. The exchange is going to close your position and you will lose all of the collateral that you had used. So this is the big difference between trading on contracts and on leverage versus just buying spot. You amplify the gains, but you also amplify the losses. And if the losses are greater than your collateral, then you lose everything, meaning the collateral you put for that specific position. Now, for me personally, I have been leverage trading for many, many years. And here's the thing, you will hear a lot of people say that you should never leverage trade at all. I would say if you know what you're doing and you understand the risks, you are able to make a lot of money leverage trading. I made my entire net worth essentially leverage trading. It is not something that I would suggest you to use if you are not familiar with trading and you don't understand it. But if you understand it and you make good use of it and you use good risk management, then it can be a very powerful tool. So when it comes to leverage trading, there is a couple of different modes. So when I showed you the trading here and I opened this trade at the bottom, I was using isolated margin. So what does this mean? It means that every position that you have for Bitcoin, Solana, whichever trades you enter, they will have the collateral per trade. So if I enter into a Solana trade, so let me just go to market order here. I want to buy one Solana. I want to go long. You can see that both of these positions, they have their own margin. This is called isolated. Now it became cross here because I failed to untick the cross margin feature. So if I go here and I click on isolated, you will now see that this changed to isolated. So that means that the margin is per trade. Now what you can also do is that you can use cross margin. So if you go to cross margin right here, it means that your entire balance that you have on your futures account is going to be used as collateral. Now, what is the difference and what is the danger? Well, if I use isolated margin, it means that I can only lose the margin that I have per position. So you can see the liquidation price for both assets right here. Now, if I were to choose cross margin, it means that the entire futures account balance is used as margin here. However, it also means that if one of the positions gets liquidated, then your entire account blows up essentially. So you can either use margin per trade or you can use your entire account balance for all of the different positions, which obviously means that if you have 10 different trades open, instead of having 1,000 margin on each one of these ones, so then $1,000 will act as margin. If you're using cross margin, it means that $10,000 in margin is being used for each and every one of these trades. However, if you reach the liquidation price for one of the assets, then your entire account is going to get liquidated. So those are the risks with using isolated versus using cross margin. Also, before you do anything at all, guys, on Pionex, you are able to actually trade with demo money. So if you go down to sign up first to Pionex, you have the link in the description, but then you click on demo here, and then you can trade with PUSD. So here you can choose isolated or cross. You can use however much leverage you want to use and everything else. And you're not trading with real money, you're trading with demo money. So that can give you the tools that you need so you understand how it actually works, so you don't have to use real funds to begin with. So how should you use this in your trading? Well, on my daily videos, I always talk about different trades. So let's say you wanted to execute a trade right now. There's a couple of different ways to do that. So the first thing is you have different order types. So first you have market order. So here you simply type in, you choose the leverage up here, you choose if you want to have isolated or cross. So you just type in how much you want to buy. Let's say you want to buy one Bitcoin, and then you can click open long, it opens up a long position. You can click open short, it opens up a short position. Also, you can tick this box, and here you can enter the take profit price and you can enter the stop loss. Now, the take profit price means that when this order is executed, it means that it is automatically going to add a take profit price. So let's say you wanted to do something like a trade where you enter right now, but you want to take profit on the trade when we reach the previous all-time high at $108,000. Then what you do is you on the take profit page, I was actually on tap it on this one, but it works the same. You can see how similar these exchanges are. So market order, I buy, we were doing Bitcoin, right? So we go to Bitcoin, we want to buy 1 Bitcoin with a market order, and then I can add a take profit right here. And then I say that at the previous all-time high at $108,000, the position is going to be closed. So that means I will make, it even states here that I will make $10,500. So that is cool. What I can also do is add a stop loss. And what does that mean? It means that I add a stop loss right here saying that, okay, I enter into a trade right now, but if we go any lower than this previous wick here at $92,000, I want to get out of the trade. Okay, so if we go back here, then you say, what was it? $92,000. That means that I would lose $5,400 here. So I can also do both. I can say if we come down to this point, I want to exit the trade. If we come up to the previous all-time high, I want to also close that trade. So in that case, I would make $10,500 or a loss of $5,485. Now this is a market order, meaning that the position is going to be bought immediately. What you can also use is a limit order. So a limit order tells you that, or tells the system that when the price reaches a certain point, only then the order is going to get executed. So what I can do in this instance is say, if we come down to $92,000, I want to enter into a trade. So I enter $92,000 right here. I have the leverage, I have the isolated or cross right here. I have the amount I want to buy. You can also use these sliders, by the way, if you want to see how things change here at the bottom once you do that. Same thing here, you can use a stop loss. You can also use a take profit if you want to do that. You can, for instance, say that you enter into $92,000. You want to take profit at the previous all-time high at 108. But if we come any lower than the previous wick here at $88,000, you want to get out of that trade. So you can do something like this in that instance, and you want to buy, let's say, 1 Bitcoin. So here you will see the calculation exactly how that would actually work out. One thing to also note is down at the bottom, you also have the margin levels. This tells you in general how much money you have and how healthy things are in regards to your trades here. If this is very healthy, you will see a high percentage and a green. If this turns into the red, you will have to monitor your positions, because that means that you're getting closer to the liquidation prices, and you will need to handle them accordingly. One thing you will hear me talk a lot about is open interest. So what is open interest? Open interest shows us the amount of leverage in the market. So how many people or how big of the general market is actually on leverage right now. So if we zoom in here, right now we are on Bitcoin, and you can see that this spans all the way back to the beginning of the year. Let us zoom in here to recently, and you can see that the open interest, the green bars here, have been going up tremendously. So what this means is that there is more and more leverage in the market. Now let us zoom in here even further. So what you can see is that this goes up and down. However, it has been going up very steadily. As the prices have gone up, more and more leverage has entered into the market. More and more people are trading on leverage. Now what you can see though is that since hitting our previous all-time high here at around the 18th of December or 19th of December, the leverage has gone down. And this is logical because here you had a big pullback for Bitcoin, which meant that a lot of people got liquidated, just like I explained previously. They got liquidated, which means that the positions got closed and the leverage got flushed out of the market. This is even more visible on different altcoins, where you see greater swings towards the up and towards the downside, and you see the leverage being flushed out, as I like to say it. Now if I go here and I click on Doge, I think on Doge you will see this very, very clearly. If I go to the just recently here, you can see that the leverage got flushed out. The Doge price here was at 47 cents, and then there was too much leverage in the market. And you can see that as the price of Doge went down, which you have in orange here, a lot of the leverage got liquidated and the positions got closed and the leverage got flushed out. And what actually happens when you see the leverage being liquidated, when you see people getting liquidated, is you see something that is called a short or long squeeze. So what does that mean? Well, essentially, when you get liquidated on these positions, if you are long, it forces you to sell that position. So it causes sell pressure when longs get liquidated. And the other way around, when the shorts are getting liquidated, let's say you were in a short position, the price went up, then you are going to get liquidated, let's say. Now, if the shorts get liquidated, it adds buy-in pressure. So that is why we call it a short squeeze and a long squeeze, because then you can have violent moves towards the up and towards the downside when a huge amount of people are liquidated all at once, and it causes this cascade, this spiral effect, and just amplifies the move towards the up or towards the downside. And this is also something that the market makers and the whales, and what is the market maker? The market maker is the people that are trading behind the scenes, the big institutions. So for every single asset that you have in crypto here, especially the big ones, you have market makers actually trading on several different exchanges. Okay, so they are in a sense controlling what the price is going to be. For instance, when the price is going up, the market makers could have a bunch of sell orders here, creating a sell wall, which could be hard to get through for Bitcoin in this instance. However, if the market makers were to remove that sell wall and remove all of the positions that they wanted to sell here at these specific prices, then that could cause the price to freely go towards the upside. So that is what the market makers are doing all the time here for different assets. Of course, it's easier for the market makers to control the prices of smaller assets. It's much harder to do that for something like Bitcoin, Ethereum, or any of these other big assets. But the reason why I explain that is because if you look at the amount of liquidation levels here, so essentially if you go to CoinGlass, you can see the yellow area right here, and that is showing us where the prices of a particular asset is actually going to cause a lot of liquidations. In this instance, we knew that there was a lot of shorts that would get liquidated right around this area. So what the market makers would want to do in this instance to profit from this is to push us into these levels right here where a lot of shorts would get liquidated. And that is exactly what happened here. You can see we went up, liquidating a lot of those short positions because people were over leveraged. So they took out this liquidity, they made insane profits, and then the prices started to go down here. But the people that got liquidated here, they lost their positions. So even though the prices at this point even is lower than where we were right here, these guys are not profiting from that price going down because they already got liquidated here. So that is why you need to be careful with leverage. The market makers, they will try to wreck you. So if you're using bad risk management, they will try to take all the money that you have in the market. So in this instance, it would be called a short squeeze because the shorts got liquidated and the price pumped as a result of that because they got liquidated and they had to buy back the position. That is what's happening when you are getting liquidated. You're either selling the position or you are buying the position. This happens automatically on the exchange as people are getting liquidated. Another thing you will usually hear me talk about is the funding rates or the funding fees. Now, if you go to, again, CoinGlass, you can see the current funding fees for each particular asset right here. Just like I explained, in general, 0.01% is the funding fees for most of these assets. Now, when the market is extremely overheated, it means that a lot of people are going long. You will see these funding rates go up. And that means that there is a greater possibility of a big flush out. And that is exactly what has been happening here recently. For instance, when Bitcoin, I think two weeks ago, when Bitcoin went to $103,000, you would see a massive flush out. So if I go to, so it's actually going to be on the 4-hourly time frame, you can see we had a massive flush out here. This was a flash crash for Bitcoin, and this was actually during a few minutes, we went from $99,000 down to $88,000 for Bitcoin. This was. So it was a big flush out for Bitcoin because people were too leveraged in the market. Now, a good way to gauge this is if you go to the funding rate heat map you can see that right now it is pretty decent. You can see there's a lot of green. Now, when you start turning into a lot of red or a lot of orange, it means like the funding rates are extremely high for each particular asset. You have Bitcoin, Ethereum, and then you have it ranked down here. So here, just with a visual look here, you can easily see if the market is overheated or not. And just know that if the market is overheated, if you see a lot of orange, the market makers, they are going to try to hunt that liquidity. They are going to try to get people liquidated, and they will try to cause a flash crash here. So just be aware of that risk, guys. But also know that the market can stay overheated for quite a while without us seeing that flush out. But it just means that it's only a matter of time until it is going to happen. You can see we started to get orange here. Even the 1st of December, we started to get really orange, and then we started to get even more here at the beginning of December, and then we saw that massive flush out. So we went, you know, almost 1 week without seeing that flush out, and we can go 1-2 weeks without seeing that as well. But you just need to be aware of the risks when the market is overheated, and a lot of people are trading on leverage on the long side, especially if that is in combination with the open interest also being very high for these assets. Now, the way I like to trade, guys, is I try to not time the absolute tops. I try to not time the absolute bottoms. Instead, what I like to use is my trading strategies right here. Now, I have separate videos going over my trading strategies in great detail. You can watch them at the top of the description. You have video 1, 2, and 3 right here going over everything you need to know about these trading strategies. But just know that these ones are also using leverage. So the same risks you have, like I explained with leverage in general, you also have these ones when you are using these trading bots. But with these trading strategies, they buy on the way down in a defined range that I have set here. So for Bitcoin, for instance, I've set 86K up to 122. And then I have different parameters also for how it is actually gonna trade within this range. But yeah, this is how I like to trade, because it allows me to buy the dip on the way down and take profit automatically on the way up. And then I can adjust this depending on the market conditions, where I think the Bitcoin and these other assets are in this cycle, whether I think that we're going to continue to go up or down, and many different factors. But like I said, I do have in-depth strategies and tutorials in regards to how to use these ones as well, but that's a separate thing. We just wanted to point out that they also use leverage, of course, which comes with the same risks as I just explained. But you are also able to use the same strategies if you want to use the same settings that I am using. I have these ones for a bunch of different coins here. In fact, I have it for probably the majority of the most popular coins. If you want to know more about that, like I said, you can go to the description of this video right here. But I'm using them on Pionex, which is my favorite cryptocurrency exchange for the moment. You can sign up using this link right here and get some nice bonuses using this link. And then with one click, you can also copy my Bitcoin, Ethereum, Solana, and Doge strategy. But like I said, make sure to watch the tutorials at the top of the description here to understand how they actually work. Make sure to check out the description also for the top exchanges that I like to trade on. You can sign up and get some nice bonuses using these links right here. Thank you so much for watching this video, guys. I hope that this was a good video explaining how leverage trading works and the stuff you need to know about it. Thank you so much, and I will see you guys in the next one.